Well. Would you believe it? I was right, eh? So if you remember last video, which I'm gonna link to the top right now, we were in this range, right? And I said, look for a deviation of this range and counter trade that. So what I said last time in that video, which you can watch clearly, is when there's a range, right? It is accumulation of liquidity on both sides, right? And what do you do when you accumulate liquidity? So there's here, orders here, orders here, orders here, here, right? So when you're at this phase, the market makers cannot reward both the longers over here and the shorters over here. So what do? They take out the shorters, the longers here, their stops will be somewhere here. So they take their stops and then go for the shorter stops. So the longers over here, so everybody who longed over here had their stops taken, right? Everybody who shorted this and did not take profit at here, these guys had their stops taken because they didn't take profit and price went above that. So the only people who really made money are the people who longed here. And if you recall last video, what did I say? I said look for deviations of the range and a sub range to form before you do anything. So what did I mean by that? So you might have looked at this and thought, oh my god, we're losing range, right? It's gonna go short, I'm gonna go short, it's all going to hell. You could have thought that and you could have shorted this move, but instead what happened? You had a freaking like 20% gain on BTCs from that point. Now in this video, what I'm gonna tell you is how exactly did I do that, right? It's not wizardry, right? So what you look for, the first thing when you look at ranges is there clear liquidity build up on both sides. So here you can see these taps, right? So these taps would be your sell side liquidity. So there's been 3 and those are just the big ones. So there's also orders over here that haven't been taken, orders, so all of this is orders that haven't been taken, right? And is there orders at the top? There's orders here, right? There's orders on the deviation of the ranges, there's orders here, right? All of these are orders. And how you determine which direction the false move is going to be is by observing market structure, right? So if you observe, let's just draw this out, right? So if you observe the first move, I'm just going to draw it a bit smaller, up, and then we keep retraced, but we still maintained market structure over here. So this is the lower low and this is a higher low, right? Market structure is still maintained overall, like in the macro scale of things. And here you go here, and this is where you start to break structure, right? You fail to set a higher high over here when you set one over here. So relative to these wicks, this is a lower high. So this is your first attempt at break of structure, right? And then you come back down for a retest, and then there's a second break of structure over here. So there's another high that couldn't be higher than the previous high that formed. So this is a clear indication and shift of market structure. So the only thing left right now is for a lower high to be, a lower low to be formed. So if you consider this a low, which you should, there's a lower low over here that formed. So this is your structure. And what this indicates over here, so let me just draw this out, right? So this is one of your lows here, and then you formed a lower low over here, right? This is a lower low, and this action of setting a lower high and a lower low, we call it change in market structure, right? So market structure is clearly pointing downwards, and you can see that it's maintained throughout the entire range, and towards the end, you struggle to get out of this. And another way to look at all of this is, let me just clear the drawings, wait, so I'll just remove the drawings, right? So you think of this as a range, get your Gann box, draw premium and discount thing, right? So this would be your premium zone, this would be your discount zone, and you can clearly see that every time that you've above 0.5, which is 50% retracement, is your premium zone, and every things below this are your discount zone, and this is the golden pocket, right? The golden pocket is where you'd look for, you know, scalp longs and whatnot. Like you can see here, it tapped the golden pocket and went up, but we don't want to go down that tangent right now. So basically how you can determine that it's going to go down is you look at the premium discount theory. So first confluence that we've had, right, it was change in market structure. So this is the first one, and then you'll have, so how this follows is every time you go heavy into the discount zone, you go heavy into the premium zone. And as you can clearly see over here, towards the latter part of the range, we just fail to go that high into the premium, or we just cannot touch it at all, right? So this is weakness in the market, right? Let's note that down. So failure to go back to the premium zone once you're pushed into the discount is weakness in structure slash markets, you know, that. So with these two things, it wasn't a big thing to narrow it down that it would go down first. But let's say you're a smooth brain like me, you have zero, like, you know, you couldn't catch it. Like, it's not that you're dumb or something, it's just that it's unfortunate because you can't catch every move, right? So there is another opportunity for you. Yes, so I say you look for deviation of these ranges. It's called accumulation, manipulation, and then distribution, right? So you look for this move, right? You wait for this range to form. Now understand that you do not get in over here. Okay, so you do not get in on this because can you guess why? If you can, let me know in the comments. Yeah, so let's track market structure for this. So you've had a down move, and then you've had a up move, right, which was your first attempt at breaking structure, but you know, it wasn't successful considering that it was this, right? And then and that is why we would not long this move. Rather, once we set a higher low, you would long this move, right? It's an attempted break of structure, you see, an attempted break of structure. So this is the markets telling you that I want to squeeze higher. So at this point, or at this point here, let me draw it out. At this point, you'd know that the markets are telling me that I should long. There is clear shift in structure. It ties into my accumulation, manipulation, and distribution theory. Okay, there's clear break of attempted break of structure. So you have accumulation, this is all your manipulation. So at both of these points, the net shorts are much higher than the net longs. So there's a lot of shorters, and what do we do to those shorters? We punish them, right? So this is the manipulation phase of it, and then you look for the expansion or distribution phase of it. Now this is where I longed personally, right? It's been shared in the Discord as well, I think. So you go here, right, towards the end. Once you see a clear uptrend that's established over here, you set your stops below the swing low, which should be this. So why you set them below the swing low is if you breach the swing low, right, it is clear breach of market structure. So you're going below your higher low. So below the higher low, it is breach of structure. So it's not upward trend anymore, at which point your trade would be invalidated. And where would I take where did I take profit? The first one that you should always take profit at is the 50% retracement in your previous premium and discount that the move formed from. So this would be your first target, then would be the range highs, right? So this would be your second target that we actually took, in fact. And if you want more updates like this and trades that I am taking, and you know, just good quality content, follow my Twitter. It is at slime_giant. Slime_giant on Twitter. I'll also leave a link in the description for you guys to go follow it, so you can follow along with my trades and updates, right? So there's that. And then you would take profit at this area of volume. So if I turn on the VPVR, right, at this point in time, you could see that there was not much, you know, like, look, I'll just mark it out. There's not much volume in this phase for it to get any resistance over there. So where would you take profit? You would take profit at the first tap of volume, and this is where I, you know, exit. So let's get that over here. So that would be your take profit somewhere over here. Now of course you can look at this and think, oh, it's a missed opportunity, it went much higher, right? So you could think that it's a missed opportunity, but in the grand scheme of things, it's a 8.56 risk to reward trade. So that means if I'm risking $100, right, so if my stop hits, I'm out $100. How much do I make by risking that $100, it is 100 times 8.56, which is $856 by risking 100, which is a damn good trade if you ask me, right? So that is how you use accumulation, manipulation, and distribution. And it is what I highlighted before any of this happened, right? I told you guys, okay, it's gonna go one of two ways. It's gonna range. You simply counter trade that range, right? So accumulation, manipulation, and distribution. So yeah, follow along, subscribe, and comment, like, all that stuff for more helpful content. I'll be posting very frequently from now. And yeah, remember to follow my Twitter for regular updates and any trades that I'm taking, right? Thanks guys, bye.